When it comes to choosing to retire, there's some important choices that you have regarding your super. And whichever way you decide to go will very much depend upon your needs and your circumstances. The first option may be that you choose to effectively do nothing. You keep your superannuation savings in accumulation phase. The downside of choosing to do this though is that those monies that you keep in accumulation phase or effectively superannuation savings phase will continue to incur tax on any investment earnings that you make. And that tax is up to 15% of those investment earnings. Your second option is to actually choose to withdraw some or all of your super as a lump sum. And there's two key considerations in this regard. Firstly, if you're under the age of 60, there will be tax implications for you to be aware of. And secondly, if you do take money out of the superannuation system, which is one of the most concessionally taxed investment environments in the country, it is very hard for you to put those monies back in. The third option available to you is actually to convert your superannuation to an income stream and to effectively start withdrawing an income or a wage in retirement. The advantages of this are over the age of 60, that income is tax-free. You still have the ability to take withdrawals in many cases, again, over the age of 60, which are tax-free. But unlike keeping it in super savings or accumulation phase, when you start an income stream, any investment earnings that you make are gross. They do not have investments tax deducted. The fourth choice you have is actually to do a mixture of all of these. So it's really important as you start to think about retirement and approach retirement and be concerned about things like how you're invested or how much income you need, that you also think about what is the best way for me to take my super. There are a couple of legislative ages that might actually drive some of your decisions. The first is the age of 60, and this is what we call preservation age. Preservation age is really the first time where the government really wants to allow you to withdraw money from super. If you've retired, you'll have flexibility around this, but even if you're still working, you have the ability to withdraw from super through an income. And this is referred to as a transition to retirement income account. The other option you have at the age of 60 is if you change employment. So this isn't changing your hours or changing the role that you do. This is actually going from one employer to another, changing your employment conditions. In this case, any superannuation you have accrued to that point will now be available to you, either as an income stream or as a lump sum. The third age to consider is the age of 65, and this is really the carrot on the stick. At age 65, the government permits you to take your super regardless of your employment status and in whichever form you want. The other carrot on the stick to consider here is that under the age of 60, if you were to access your super in some way, is that tax would apply to it. Over the age of 60, tax will not apply and you'll receive any income or any withdrawals you take tax-free. So let's just unpack that tax a little bit. When it comes to your superannuation, depending on how that has been accrued over time, will determine if you need to pay any tax. Any contributions that have been made by an employer that you've put in and claimed as a tax deduction or put in through salary sacrifice, as well as any investment earnings that you've made throughout the life of your super, these will be classed as taxable component. Effectively meaning that if you withdraw these monies prior to the age of 60, there will be tax implications for you to consider. On the flip side, any personal contributions that you have made which you have not claimed as a tax deduction, any contributions a spouse has put into your account, as well as anything you have put in through downsizing your home, as well as anything the government has put in, will be classed as tax-free component. So regardless as to the way or the age at which you withdraw these monies, where you meet a condition of release, no tax will apply. So just to summarise that, when it comes to taking income from your super, be aware that under the age of 60, there will be tax implications. Over the age of 60, it will be tax-free. And likewise, when it comes to lump sums, that if you choose to take a withdrawal under the age of 60, there will be tax considerations again that you need to account for. Over the age of 60, any lump sum withdrawal will be tax-free. The point of this is to show that the government is enticing us through tax concessions to try and keep our money in super till much longer in life, till age preservation age. Where you're still working, but you've reached age preservation age, you have the ability to start withdrawing your superannuation through the form of an income. You can do this by using what is called a transition to retirement account. There's a couple of key things to be aware of though. From this account, you cannot make lump sum withdrawals, and also any investment earnings you make, like your superannuation savings, will continue to have tax deducted at up to 15%. So where are the advantages? Well, the first thing with a transition to retirement account is that you can continue to invest it the same way as you do with your other superannuation savings. You do not need to change your investment strategy unless you really want to. The second advantage, as I alluded, is that you can start withdrawing an income up to 10% per annum. That cap is applied because, as the name insinuates, this product is intended to help you or supplement your income as you transition to retirement. There is still the need for you to have a balance to call on in retirement when you get there. The third thing is that this transition to retirement account, where set up properly, can provide certain individuals with tax advantage. And that is because the income that is paid from a transition to retirement account could be lower than the tax that is applied to any income you earn through employment. Effectively, you have a wage paid from your transition to retirement account while you're diverting income from employment into your superannuation savings, either as a salary sacrifice contribution or a contribution that you claim. So there is the ability for you to start withdrawing money as an income from your super while you continue to contribute. To try and illustrate that better, when it comes to commencing a retirement income account for transition purposes, we actually move part of your superannuation savings to what we call a transition to retirement account. From that, we will start to actually pay you an income, and you can also make salary sacrifice contributions to your super. Any amounts of that income that you're taking out that you do not need, you can actually recontribute back to your super. And there's really important strategies and opportunities that may have you thinking about that. Alternatively, where you're withdrawing more income than you need, you may choose to contribute that to a spouse. As this shows, there are really vital considerations for you to make when it comes to a transition to retirement account. How much do you want to commence it with? How much do you want to withdraw? And what can you actually do in regard to recontributions or tax minimisation? It is important that when it comes to setting up one of these accounts that you do reach out to us or seek guidance from an advisor, either with us or of your own choosing. When you're at the point of retiring permanently, you can commence what is called a retirement income account. And it is very much the same as what we've just gone through for a transition to retirement account, but with some fundamental differences. Firstly, any investment earnings that you make will now be tax-free. So you're earning gross investment earnings on your account balance. Secondly, you are now in control of your income in full. You can withdraw as much as you want, subject to minimums that apply. You're also able to now take lump sum withdrawals as you need and want. And remember that over the age of 60, any income that you take, as well as any lump sum withdrawals you make, will be tax-free. Under the age of 60, tax implications may apply to you. The other thing to note is that where you start a super savings retirement income account with Australian Retirement Trust, a bonus will apply to you that you can take advantage of. There are eligibility criteria that apply, so we encourage you to visit our website for more information, both on the bonus but also on the product itself. So as I mentioned, you have more flexibility when it comes to your income, but there are minimums that you are required to meet. You are required to take a certain amount from your account balance each year, and this is basically as a compromise to the government in them affording you with very generous tax concessions. They provide those to you on the basis that you are using your super for retirement. Those minimums are based upon your age, and in recent years, largely as a result of COVID, they have been lowered. Again, you must think about though, what income do you need in retirement? You may in fact need more than these minimums that are shown. And it's important that you not be frugal and that where you do need more, you consider taking it. Noting no maximum limit applies to a retirement income account. You also have the flexibility with most of the products in this area of deciding whether you'll take these payments fortnightly, monthly, quarterly, or even annually. In effect, you can replace your employment income wage behaviour if you wish, or change it to meet needs that you have with income in other ways. The other thing to note is, again, that if you are commencing a transition to a retirement account, these minimums will apply, but a maximum will also apply to you. Once you permanently retire, that maximum effectively disappears. So let's weigh up those choices and think about why you may want to consider one option over another. As we've outlined, you can start a retirement income account, which effectively allows you to start taking a wage from your super. This gives you the ability to take lump sums as well as receive that income, and over the age of 60, those are paid to you tax-free. Likewise, any investment earnings you make will also be tax-free. The thing you need to consider though is there is a minimum amount you must take each year as income. The second decision or choice may be that you leave it in super. And you can still take withdrawals as you choose to, but remember the disadvantage here is that the investment earnings you make will continue to have tax deducted. Remembering that for a retirement income account, the tax on investment earnings is nil. The third and final option is that you choose to actually withdraw your super. But remember that what this will effectively do is cease any opportunity you have in the most concessionally taxed investment environment in the country. Once you take super out, it is very difficult to put back in. So once you take it out and put it into other investments or other savings, be aware there are going to be taxes that apply there that otherwise wouldn't have applied to it when it was in the super system.